Just opened up a few minutes early here, letting you all get in. I'll make a few announcements when everybody gets in, but we have a very large crowd today. So I just wanted to get everybody starting to get in here, and we will get to announcements shortly. As you are coming in, I'll let you know, today is interactive. Our whole goal is to answer your questions. I just want to let you know ahead of time. There are 4 questions that we have gotten quite often in the last couple of weeks leading up to this. And so I just want to let you know, we're going to address these 4 I have on this login screen, or this first screen, first. So if one of those are your questions, obviously know that we will address that. If you have other questions that I have not listed here, and please, I would rather you make them more general, not client specific. I can't really answer something on your client directly because I don't know all the facts and circumstances, or we don't. But if you have more, general scenarios, great. Put those into the Q&A as you log in here, because really our whole goal today is to answer your questions. And so Q&A is going to be the spot to start putting those in. We have a lot of people yet to log in, so we are not going to get going for a couple minutes yet. Anybody notice my new background? I got a new desk behind me, inside information there, a new table. Again, just as people come in, I just want to make this announcement. Here's the top 4 questions we're going to address immediately. These questions came through in the last few weeks as people were registering. They had reached out to me with questions, and these are the most common questions that came in. So we're going to address these first. So if these are one of your questions, obviously know we're going to get to it. If you have a question other than these, I'm almost guarantee we will get to it, but you're going to help us by putting those in the Q&A. So please put any questions you have specifically into the Q&A, and that's the whole goal of this presentation today, or it's at least 2/3 of the goal of the presentation today is to answer your direct questions. And so we're going to need to see those in the Q&A. I see someone put one in chat. We will go grab that out of chat, but please put them in the Q&A. 2 different buttons there. All right. We're officially at start time. We are way under attended right now. Mark, do you know if there's something going on with some of these registrations?
Yes, I'm actually dealing with that right now. I just sent an email over to CPA Academy to give them the link one more time, but I am also sending them directly to people who are responding to us. So.
Okay. Yes, apparently anybody that signed up through us, through Termerit's website, you're in. We had decided to put this one available for CPA Academy as well. And for some reason, that group has not logged in, because we have nearly 2,000 attendees signed up today, and I currently have 160 of you in here. So if you be patient, I'm going to wait another minute or 2 and see if we can get everybody in here. All right, I see somebody saying CPA Academy didn't send out the okay. All right, well, they will catch up. We are going to be staying on extra time, so I think they'll get their 50 minutes in, assuming they can get on as soon as possible. So let's get going. Hey, it's a minute and a half. I really want to let everybody get in, because this is important stuff, and the attendees seem to be increasing again. So maybe everybody else is getting in. Sorry.
Catherine, there will be CPE credit for this presentation as well. That'll all be sent out afterwards.
All right, I'm going to get going. We're going to start. As I said, we still have about over 1,000 people to log in. I'm a little disappointed that that is not working correctly for the CPA Academy group, but hopefully they will be here shortly. top 4 questions we're going to talk about. The goal of this whole presentation today is employee retention credit, a virtual roundtable. We're here to answer your question. That's what we're doing. We are getting questions nonstop still on employee retention credit, which I'm not surprised about, partly because there's a lot of misinformation out there. And so hopefully we'll address not only your direct questions, but we'll help educate you on what is accurate when it comes to employee retention credit and what is inaccurate. The housekeeping items I want to go over. This is CPA eligible. You need to answer 3 of the 4 polling questions to be eligible. You need to stay logged in for at least 50 minutes to be eligible. We are going to stay on longer. It's a 1-hour CPE. We are going to stay on longer just to continue to answer any questions you have. So the 50 minutes shouldn't be an issue as long as you can stay on. The Q&A, again, not the chat tab. Type your questions into Q&A. If you do that, we will know to address them. And we have people behind the scenes that are typing those into another document as we speak so that we get that. We are going to be sending your certificate out to the email you addressed, the email address you registered with. And if you're here through CPA Academy, that'll follow their procedures. You should get an email from them. It'll show you how to get that certificate. You can see them live. Here's their pictures. This is our panel for today. Besides myself, we got Nick, Haley, and John. Nick has been very active on the ERC from a 941 standpoint and an overall standpoint as well. So he'll be able to answer those questions. Haley heads up our production team for employee retention credit. So she sees the actual work being done. She sees the documents that we receive from the clients and what we don't receive that we should receive. So she can address those types of issues, among other things. And then John Kapral, very knowledgeable from a tax and IRS procedure standpoint. So he'll be on top of all those areas as well. So that's our group. In addition to myself, we have Barry Devine and Danny Anderson, who are behind the scenes right now, weeding through the questions as they come in and making sure that we all know what's out there so that we can answer them. Barry and Danny and myself were the 3 people that actually set up this ERC team. And so we are in the going in the Wayback Machine right now to the start. This is the 3 of us that really were working hard together 16 months ago to get this going. So you've got the A team here answering your questions. I was going to skip this, but since we do have a bigger crowd today, what I want to talk about briefly is that we've got some recognition as a company. It came to me personally, but it's really a company recognition for all the work we've been doing on ERC and other things. Accounting Today this past year listed me as someone to watch as one of the most influential people in accounting. And really, like I said, that's a company thing. That's because I think all the hard work and the support we have done for the tax preparation community. Tri-Merit, specialty tax professionals. We support the tax preparer and their clients by really serving an extension of their advisory team and looking to lessen the tax burden on taxpayers. That's everything we do, lessens the tax burden on taxpayers. And it's all specialized area. Beside the ERC, R&D, cost seg, WOTC, which is the work opportunity tax credit, and then a couple of residential incentives, 170 ID and 45L. Those are areas that we support the industry with. What's today's agenda? I want to get to the Q&A here pretty fast. What's today's agenda? We still have people logging in, so hopefully this is getting corrected in case you guys didn't hear it at the beginning. CPA Academy is also joining us today, but there seems to be a little issue there. So if any of you are from CPA Academy's login, let me know in the chat, not the Q&A. I just want to see if CPA Academy's people are getting in right now. Okay, agenda today. Agenda is quick overview of ERC, quick overview. I'm assuming you all know it, but I'm going to talk about it just briefly. And then it's a simple agenda, your questions. We have some that we got pre-populated, but we're going to look to answer your questions today. There are a lot revolving around the employee retention credit still. First thing, key info. Let's just talk about the ERC General, but very briefly is, what is it? Well, it's a credit. It's a credit that's just a refund check is what it becomes. How does your taxpayer, how does your client qualify for this? There's two ways that you can qualify for the employee retention credit. The first is a simple math equation. We do the math. If you hit the math, you qualify. Safe harbor rule, no questions asked, you qualify. And that math is, did we have a drop in revenue of 50%, at least 50% in any quarter in 2020 when we compare it to the same quarter in 19? Or in 21, was there a 20% drop in revenue in any quarter when we compared that same quarter in 19? We hit that math. Now, there's some other rules around that a little bit. Once you qualify for one quarter, you probably qualify for the next quarter. You could pre-qualify quarters, but that's the general math. We get that, we qualify, no questions asked. But that's not the only way to qualify. The other way we can qualify is if your business was restricted in some way by a government mandate. And so if we had that government mandate in place that restricted your client's business or your business, that's what we're going to want to expand on, because that's where there's a lot of questions. And that's where there's a lot of misinformation coming out on that as well. What is a mandate that will qualify me? So we're going to expand on that a little bit. That's going to come out in some of the Q&As we already got, and some of the Q&As I'm sure we will continue to get. That's how you qualify. What's the value of this credit for your taxpayers, for your clients? The credit is 50% of the first $10,000 of eligible wages in the year 2020. So the year 2020 was an annual credit, annual being March 13th to the end of the year. You still have to qualify for whatever portion of that year, you could potentially get the credit, but that's the time frame we look for 2020. Annual $10,000 of eligible wages per employee, 50% of that, up to a $5,000 credit per employee in the year 2020. The year 21, that got enhanced. It's now a quarterly credit. It's now a 70% credit rather than 50. So we get to look at every single quarter individually, see if we qualify. If so, what's the value? 70% of the first $10,000 of wages eligible per employee per quarter. So up to $7,000 of credit per quarter per employee if we qualified for all 3 quarters in the year 21, because this ended at the end of September for all businesses except a special definition of recovery startup businesses. So overall, if we look at really 3 quarters of 2020, last 3 quarters 2020, first 3 quarters of 21, there's really 6 quarters for the most companies that potentially could be used to qualify. If that's the case, one employee, if we qualified the entire time, could be worth up to $26,000 in credit. That's how this works. That's the basics. That's the key info that we need to be thinking about as we're talking through the questions today. Now, I want to go to a polling question right away. Get this first one out of the way, and we are going to launch. Nick, were you saying something? No. Okay, sorry. I thought someone had a. All right, polling question number 1. Really, what question do you want us to address first? We're going to address all of these. Is there one of these that's more important to you than others? And this is just what I wanted to kind of get a feel for the audience and what you think the most common things are. And the way the voting is going right now, I'm not going to, is the way I expected the voting to go. But oh no, there's a surprise to me. I got number 1 I got, but the others I didn't. All right, while you're still answering that polling question, if you want to ask us any questions in addition to what you're putting in the Q&A today, you can either scan, take your phone out, scan that QR code, that'll bring you right to our email address, or it's simply info@try-merit.com. You can send us additional questions that way. Let's say we don't get your question today, or there's a question you just don't want to ask on this, or maybe more in-depth question than you think we can answer today. You can send additional questions there. All right, we are 92% voted on poll number 1. So I am going to close this right now. Somebody just snuck in under the wire. We are closing the poll, and the question you want to hear about first is an update on IRS processing times and procedures. And so we will get to all of these. I may take your suggestion and go in that order. I may not. We shall see. But no, I thank you for answering that question. In fact, I am not, unfortunately, going to go into that order right now. The first thing that I want to address, because this is a question we get quite a bit. All right, I'm going to listen to you. We're going to go, just kidding. We're going to go to the IRS timing and procedures. So we are going to go to that first. And hey, you got to have fun on these. And so with that being said, Nick, number 4 on this list, can you give us an update on the current IRS processing times for the ERC submissions?
Sure. And there's a couple questions that came through around that with kind of a similar theme. But so as everyone's seeing, there's obviously a big backlog in what's going on at the IRS. With having to paper file 941Xs, the IRS is short-staffed, just like everyone else right now. So I've talked to the IRS quite a few times. What they were doing is, as they were leading up to tax season, they actually took people out of working on paperwork and covering the phones so that they had enough bandwidth to be able to handle any questions that came up during tax season this past year. So what started as a delay became a major delay. And when I talked to them, they said they were going to be shifting people back from phones into paperwork as soon as we got past 415. We are starting to see that a little bit, but just to give you an idea of what we were seeing during the backlog. So if you're not registered for e-services, I highly suggest it. You can pull transcripts in real time, see what the IRS is doing, at least make sure that they're receiving the 941Xs you're sending in. We've had multiple cases where we send in 941X and it's never received or it's lost in processing. Sometimes the client gets a notice saying so, sometimes they do not. So the IRS is very overwhelmed. So I always suggest get the e-services so you can at least check to make sure your forms are being received. The IRS, what they tell you is it takes up to 120 days just to show that they've received your form that was sent in. So that's 4 months just to say they got it, not even to process it. Sometimes it can be quicker, sometimes less. We're actually seeing that pick up quite a bit since we got on the other side of the 415 deadline. We've actually have a client who we had sent in the forms on 3/14 and now it's showing as received, versus 2 weeks ago we had clients who were sent in the end of December that weren't showing as received. So we're hoping to see a big push by the IRS to speed this up. But as of right now, we're still not seeing much difference in time for processing. So the total time for processing and what they have told me that their threshold for kind of pulling extra review is $100,000. So if you're filing a credit that's under $100,000, they're trying to get those paid in about 5 months or so from when they're being sent. That's what we were seeing, previously. Will that get faster? I think so. As they've shifted more people into paperwork, we'll probably start seeing faster processing times along the way. They've also done they've tried to do quite a bit of hiring to get more and more staff to try to fix this. Their goal is to try to fix it by the end of the year. I don't know that they'll be able to do that. It's a huge task considering the volume that's come in. But when you're talking about credits under $100,000 right now, we're seeing 5 months. And that doesn't mean that if it's over 100,000, it's going to take much longer, because we have some clients who have had credits in the $200,000 range, $300,000 range, and they are being paid. But that's just the number that they told me over the phone. They said if it's over $100,000, it's subject to having a second review before being processed. So with that second review, that's where you're seeing a huge delay. And I think the biggest reason there is, one, they're probably comparing things against tax returns, seeing how big the client is, making sure they're avoiding as much fraud up front as they possibly can, because it's going to happen. Just like we saw with PPP, the cases of fraud, it's going to happen with this too. So they're trying to take precautions as much as they can to prevent that. And the $100,000 is per quarter. Sorry for that. Thanks for pointing that out, Scott. So yeah, that was what they told me, $100,000 per quarter. Now, again, we've had some clients with amounts above that have gone processed quicker. But it just seemed to be a trigger where they might start looking at a second review. They couldn't tell me much else for what triggers a review and what doesn't. But just to know, if you have any clients filing a quarter for more than $100,000, should expect it to take longer. If it comes quicker, that's great. One other thing we've noticed is when you have a client who, let's say you filed, and this probably isn't going to apply anymore, but in the past, you may have filed a couple quarters. Let's say you did 2020 and filed 2020, and then you went back and did 2021 later. We had some clients where we filed 2020 in July or August, and then 2021 we got filed in September, October. They actually got all those processed together, and we didn't have to wait as long for 2021. I asked them about that. They said pretty much if it gets to their desk and it's the same person assigned to work all the quarters for the business for 2021 and 2020, then sometimes they'll pull in those quarters that were received later and process them as well. So you may see quicker processing if you did something like that. I'm guessing by this point, because we're past the ERC eligible period, that's not going to happen as much anymore. But there's something we saw as well. The biggest takeaway, though, is if it's been over 120 days from the time you filed with the IRS and they're not showing that they have received it, you need to have your client refile at that point. And unfortunately, there's nothing else we can really do. By then, when you do have them refile, just make sure you mark that it's the second submission, so that just in case the lost one is found, they're not double processing or anything like that. And then with that, I mean, the only other thing we can say is, just obviously try to have patience and keep checking in. But any smaller claims, we should be expecting from now on about 5 to 6 months from what I've been told. Sometimes faster, sometimes longer. But once you're over that 100K threshold, we have clients that are running on 10 to 11 months that we're still waiting. So we don't have an exact timeline, but that is all the information the IRS has given me.
Hey, Nick, I saw some questions in the chat as well that were asking about the timing for returns that were filed on the original 941 as well.
Gotcha. Yep. Original time 941s, for the most part, we're seeing those in a few weeks. We actually had a client who they had filed the original 941. The IRS never received it. It was showing that they didn't receive it. So when we went to go claim the ERC, we actually put the ERC credits on that 941. We e-filed it, which was, months after when it should have technically been due, and it was processed within 6 weeks. So we're seeing a lot faster. I think the longest I've seen with a timely filed was about 3 months for a larger credit. I think it was like $650,000 credit for that quarter for the client. But for the most part, if you're not seeing something in 3 months, I would say it's worth contacting the IRS to see what's going on for timely filed.
All right, great, Nick. Thank you. The first question that's popping up here is one that you and or Haley can answer. So I'm going to go to this first one just because I figure if you're early in with the questions, you get to go first. So we had a question about the impact of using a PEO and how that can slow down potentially the processing and the procedures for that. It says, when can payments expected to be received after filing 941, 941Xs if we're going through a PEO? Do either of you have updates on that?
Yeah, so with the PEO, every PEO is different. And that's what makes this such a hassle, because we have some PEOs we worked with where they are taking the information they're gathering for all their clients. Are saying, you need anything you want amended for 2020, for example, needs to be submitted by X date. Otherwise, it's going to have to be on the next amendment. So they're not doing amendments in real time when you get in the info. They're doing group amendments with their clients. And I know that we see that quite a bit. And PEO is it depends on. Yeah. So Haley, I don't know which companies we work with lots of different companies for it, but have we actually had any PEO clients where the PEO's given them the credit yet?
Not that I'm aware of. So that's the challenging part. And I will tell you that PEOs have been not the most helpful in helping with ERC. So in the case of a PEO, we at Trimerit like to be as involved as possible with that, and making sure that we're talking to the PEO representative and making sure that they're getting all the information filed correctly with that. A lot of times PEOs will make the clients fill out the PEO's own ERC information, but they don't tell the client that, so it just sits there. So that's something that we like to watch out for as well. As far as receiving the refunds yet, I've heard different things. I've heard that some PEOs will give a credit to the client on their account. I've heard that they will actually be sending the check back to the client. So a few different options there. Honestly, it depends on the PEO, but no, I haven't heard any that have been received yet.
All right. All right. I'm going to answer one myself, and then we're going to go to John for after that for IRS, penalties potential and timing issues with expense adjustment. All right. So the question I'm going to answer is this next one that came in. So is it accurate that an employer can qualify for the credit if a full or partial suspension of business operations due to COVID, maybe one word in there wrong, COVID, even if there's no impact to the company's gross receipts? Now, that's a little bit of a trick question. Overall, we do not have to have an impact to gross receipts. What we do need to show is that this government suspension, this government mandate affected more than a nominal portion of their business. This is right in the IRS explanation of this. So more than nominal is defined as more than 10% of their overall 2019 operations from revenue operations, or 10% of their overall hours worked in 2019. And so an example, and I use this example all the time because it is personal to me. I'm actually part owner of a craft beer bar in Chicago, in addition to having a lot of fun educating people on the employee retention credit and other aspects of the tax code. We did not have an overall effect to revenue due to COVID. Overall, no. There was we have a bar and we have a liquor store all in the same location. Bar was under suspension rules, under mandate from March 17th of 2020 till June 11th of 21, well over a year. If you looked at the financial statements, revenue was up. So if you were going to qualify this business just on revenue reduction, you would look at this and say, no, they don't qualify. But that's not what IRS says. IRS says, did we have a portion of our business that was affected by a government mandate? In this scenario, bar was greatly affected. It was closed down completely for a significant long amount of time. And then it was under a 50% or even 70% capacity restriction for a significant amount of time. Now, liquor store sales went through the roof. People were buying beer and wine and spirits to drink at home. And there was other reasons revenue went up, virtual online tastings and all that. But more than 10% of our 2019 bar portion, about 40% of 2019 revenue, was affected by a government mandate. Therefore, the entire operations is affected, even though liquor store sales went through the roof. So yes, that's an overall receipts not affected, but portion affected. That's what we need to be able to show. And that question goes on to further to ask, what qualifies for a full or partial suspension? Well, I think I defined that kind of what we said, a suspension that's going to affect more than a nominal portion of our business. Most common capacity restrictions, restaurants, bars, theaters, gyms. That's the most common. But there's other ones out there as well that can potentially affect us. But that I just warn people all the time, do not just look at the overall top line revenue number and try to qualify or disqualify a company based on that. You have to dig deeper. You have to break that down into segments. Okay, I'm going to stop there. And we're going to go on to John now. And John, do you want to address the whole timing of the expense reduction for the credit, and should we be concerned about any penalties and interest on doing an amended return to do this?
Sure, Randy. Yes, thanks for joining, everyone. We got some important information end of, beginning of last week when everyone was finishing up their busy season, of course. And we need to promulgate that. We need to share that with you today because this really is important. It's a technical procedural matter, but it's something that if you can address it on the front end, it can save your client on the back end. And so what I mean by that is IRS issued an information notice last week that reiterated something that was in one of their earlier notices, notice 2021-49, relating to the 280 cap C adjustment. Now, the 280 cap C adjustment, as you know, when and this is a general rule that applies to certain specific types of credits, but when there is a credit of this nature, the employee retention credit in this case, that is awarded to a taxpayer, they need to adjust their expenses by reducing their, in this case, employee costs. And so the wages they paid employees that otherwise deduct, they have to reduce that deduction. In effect, their income goes up, their taxable income goes up. So what we've got here is a similar treatment, and that has been codified. This started with the CARES Act. It has since been codified in section 3134E, where an ERC credit, in other words, needs to be added back to the expenses for wages that a taxpayer had taken. Now, a couple of things that come from that. Well, what if this was not done? Taxpayer identified the ERC later, filed a tax return, and then we're going to wait on their ERC. What happens with this adjustment? Is taxpayer expecting to get this ERC credit? Do they have to wait until they get the credit? Can they wait until they get the credit? Well, it's pretty clear that the taxpayer needs to amend their return when they file or within a reasonable amount of time of filing for their ERC. Even though it's income tax versus payroll tax, the issue really comes down to whether the taxpayer timely paid their tax. And there is no allowance for deferring recognized income, and that would be what this amount is, this add back for the ERC. And so taxpayer would be subject to not only failure to pay timely penalties on the tax, but also potentially failure to deposit penalties. So if not for this notice, this information release and notice, the information release that came out last week is 2022-89, says that a taxpayer, if their actions were reasonable, would be able to avoid the failure to deposit and the failure to pay penalties, and that would mitigate a substantial potential penalty and interest. So the scenario there where taxpayer files their amended return to add back this ERC, these ERC wages, the question remains, what if they cannot pay that tax at this time, at that time? Well, what they can do is file for or seek an installment agreement through their CPA if they cannot pay the tax on time. And what that can do is allow that grace to carry with, so that the failure to pay penalty will not be assessed. The other scenario, taxpayer files their ERC, does not recover their ERC, but fails to amend their tax return to reflect the ERC wages. If that's the case, then taxpayer is exposed to the potential for the failure to timely pay penalty. The tax would have been due on April 15th, for instance, in a calendar year situation, but for the ERC, that filing was correct, at the time, this ERC claim creates an obligation to amend tax return. And so that's what this notice and information release are doing. They're granting some relief against interest and penalties for this failure to pay and failure to deposit penalties. Another aspect of this, it's more extreme, but it's certainly in the larger credits can be an issue, is accuracy related penalties and of course preparer penalties. And so this is an issue that has some ability to be mitigated very easily to avoid substantial costs down the road. And so our position after this notice 2021-49, as reiterated in information release 2022-89, is when you file your ERC claim, taxpayer or CPA filing for your taxpayer client, it would be very prudent to amend that income tax return within a reasonable time period to avail yourself of this grace from the failure to timely pay penalty and of course the failure to deposit. So that's our position. It's very clear there is guidance that's substantial authority in this section 3134E that requires this. And so it simply can't be relied upon as the argument that you have not received the refund cannot be relied upon as a reasonable basis for not amending your tax return. There was a question raised already in the comments in the chat Q&A, and that question would be answered by the discussion we just had, and that is it would be prudent to file the amended tax return when the ERC claim or within a reasonable time of filing the ERC claim.
Great. Thanks, John. I'm going to go to polling question number 2 while we continue to talk here. So polling question number 2. And again, I'm going to launch this. If you got on late because of some troubles that we're having with CPA Academy's registration, there's still going to be 3 more polling questions, and we are going to stay on extra time as well to continue to answer questions. And so you can get your 50 minutes in as well. So I just want to see if anybody has had any of their clients had an ERC audit. So official audit, not just a notice saying we made changes or anything, not just a, hey, we got less than we expected, but a true audit. Because I personally have not, and we have filed, Nick can verify this, what have we filed? 6,941 X's or something at this point, Nick, or am I overestimating?
Or
underestimating?
Yeah. That could be right. I mean,
yeah.
Over 1,000 clients. So it's as many as, 2 or 3 6 quarters per client.
Yep.
Yeah.
All right. So we have not seen an audit. We actually have 100% of you responding on this right now. That's awesome. And 3%, 12 of you have said that you have seen an IRS audit. I'd be really interested to get information on that. At the end of this is going to be my email address, or you can send it to info@. I'd love to hear anything that you know about that audit procedure that went on and what happened during the audit, because we deal with CPA firms around the country that are doing this, and we're doing it, and I have not heard of an audit yet. So that'd be really interesting to see what's going on there. So thank you for that information. All right, with that being said, let's continue on to your questions. We're getting a lot of great questions here. And Haley, I'm going to go to you next. Sure. We have a lot of questions coming in about the whole PPP and ERC interplay, and a few of them specifically talking about, the wages used for forgiveness, if they exceed, let's say that we had a PPP loan of $100,000, and our wages during the forgiveness period were $2,000. We put $200,000 on the forgiveness application, but we only needed 100 to get full forgiveness. Can we still use that additional wages towards ERC? So that's a specific question, but if you want to give us all overall interplay, however you want to address this.
Yeah, absolutely. So the main thing here is, just as I'm sure you guys know, to not double dip on wages. So there's a few different state and federal grants and loans that we take into account and have to look into when doing the ERC calculation. I'm going to go over just a few of them here. So the first and most common, like Randy said, is going to be your PPP loan. As you'll know, there was 2 rounds of it. Some clients got one, some clients got both of them. Just depends on their business specifically. What we use as a guiding document for taking that interplay into account is going to be the forgiveness application. So this is really important for us to have when, like I said, looking into calculating the employee retention credit for each of our clients. Some of the important information on that 3508, 2 very important things. The first is going to be the time period, or that covered period of the PPP loan. That's going to help us, like I said, make sure we're not double dipping on any wages that were attributed to payroll or to the loan. And then the second thing that we look at are going to be where the loan was attributed to. So that's where the payroll or wages versus other expenses come into play. So with the PPP loan, you had to use at least 60% of that loan towards payroll, but you could use 40% of the loan towards a few other categories of expenses. We are advising, if any of your clients have not filed for forgiveness yet on PPP, make sure that you attribute the loan to as many other expenses as you can. This will free up any wages that would be available for ERC. So we have to take that PPP loan into account first, but any wages left over in the PPP time period after we take that loan into account can be used for ERC. So a common misconception with a PPP loan is going to be if the PPP loan can be, can we use wages, like Randy just mentioned? If we had a $100,000 loan and there was $200,000 of payroll expenses in that time, we can use that other $100,000 in wages towards ERC. So that's a very common misconception. You can use wages for that employee retention credit. And then some of the other grants, for instance, the restaurant revitalization grant, as well as the EIDL advances and the shuttered venue grant. Those are a little bit more flexible, and we have some more room to work with. They can be used for a lot more other expenses, and there's no cap. So you don't have that 60-40 breakout where 60% of the loan had to be attributed to payroll. And a lot of times those are smaller than a PPP loan. So especially with the EIDL and the shuttered venue. So we don't see a lot of issues with those, but it's all about, the main takeaway here is going to be however those grants and loans are reported is what we have to go by when looking at ERC. So, and then the other main takeaway here is going to be attribute as much of the loan or grant to other expenses as possible so that we can use the rest for maximizing the employee retention credit.
Great, Haley. Thank you very much. Nick,
just-
yeah, go ahead, Nick.
I'll say before we move forward on that, there was one other question that was kind of related to that. It was talking about the FTE reduction quotient for PPP forgiveness. So this is something we haven't seen a lot of. We've had a lot of clients qualify under safe harbor for their PPP, but if you needed to have more wages to be able to get full forgiveness for PPP, so the example he gave is PPP loans, $90,000. You needed $100,000 to meet the $90,000 payroll, threshold to give PPP forgiveness, because you either hadn't brought back employees or you let go of employees, so you didn't meet the threshold needed for the full 100% of expenses used. In that case, you have to use back out that higher amount. So if you have a $90,000 loan and you have $100,000 from of wages required to satisfy the $90,000 load due to the FTE reduction quotient, then you need to back out 100,000 of wages. So that's the only exception to that rule, where any excess, and I don't know if everyone has aware of that. I know it's again, it's not super common. We have a whole lot of clients just qualifying on a simple form, but it does come up. So I just want to address that.
Perfect. Nick, while you're talking, there's another one here. I think it should be easy, but this came in pretty early on. Can a company that reports taxes on a cash basis use the accrual basis for determining revenue for eligibility, since collections are very sporadic?
Short answer, no.
Yeah.
The IRS pretty much came out of their guidance, said whatever is your tax, basis for filing, you have to use that for your qualification for gross receipts.
Yep. That's exactly what I was going to say. So I want to address that. We're getting a lot of questions right now on supply chain issues. So I'm going to address supply chain issues along with a very large soapbox item of mine, supply chain being one of them, but information that everybody in the country qualifies. We're hearing this because there are some people out there spouting this, that everybody qualifies. And what they're using to say everybody qualifies is a combination of OSHA and CDC rules. Spoiler alert, this does not work. So I want to let you know right off the bat, what I'm talking about here is how you cannot qualify based on the OSHA and the CDC guidelines. So this is not, this is my opinion, but this is, you would have to stretch this a million miles, in my opinion, before this would qualify. So here's what they're trying to do. OSHA has some rules. CDC has some guidelines. To qualify, that has to be a mandate. OSHA guidelines for COVID are not mandatory. It's not mandatory. It's not a mandate. CDC guidance, it's called guidance. That's not mandatory. Now, it could be mandatory. Am I saying that word right? It sounds so weird. Mandatory. There you go. It could be mandatory if a state enacts CCC guidelines. See, there's guidance out here. The state makes that a mandate. Sure, now that's a mandate. In general, CDC by itself is not a mandate. So that is not. That what they try to do is say, okay, well, OSHA has this general duty clause that says that we cannot do anything that's going to endanger somebody's health or life. And therefore, we're going to take this and bring in these CDC guidelines, and then we're going to say, because of that, these OSHA rules become a mandate. If you even want to do that, the mandates have to be in response to COVID-19. This general duty clause was written in 1970. That is not due to COVID-19. The law specifically says that these mandates have to be out there to help protect us in a COVID-19 situation. So this is the very short answer on this. And we can go one step further. Even if we can try to argue, which we can't, but if we can try to argue that this does create a mandate, it still has to have an effect. And most of these companies are trying to qualify on states that did not have many mandates. Let's say a Florida or a Texas. There's certain states, even Wisconsin, where the mandates just were not in place that long. And what they're saying is, well, because of OSHA rules, it doesn't matter about the state mandates, you qualify. They don't go the step further that says, okay, now show me the more than nominal effect that this, even if we could say this is a mandate, show me the more than nominal effect this had on your business. Well, there was no state restrictions. You weren't under any capacity restrictions. You weren't under any shutdown rules. And so you're going to have a very hard time even showing that this affected your business, which you have to do. And so that's why this argument doesn't hold water. Now, I got a lot of my information on this from Dan Choden. Some of you might know Dan's been really, really good with dealing with the employee retention credit, and I think looks at it correctly. So I just wanted to give him credit on some of this he wrote in an article for Think Outside the Box. So Dan's a great guy. Dan's going to be on my podcast sometime next month. We're going to record, so we're going to geek out about ERC. So if you are interested in that, we will be having that out there. Now, my next soapbox item I want to talk about is, and I don't think it's on this list here, but the questions coming in. Talk about supply chain issues. Can supply chain issues qualify us? IRS specifically has addressed the fact that if you are affected by supply chain issues due to COVID mandates, you can qualify. Now, I don't know, Haley, if you can tell me this, have we qualified anybody yet on a supply chain issue? No. So
Yeah, I don't think so at all. We've tried. We have definitely tried.
Well, we've tried a lot.
But,
We've
yeah.
got 1,500, 2,000 clients, whatever it is. We have not been able to find a supply chain issue that has allowed a business to qualify. And so let me explain that. We all know there's supply chain issues across the country. We know that. This is a huge thing in our country right now. It has been for a while. Why is there supply chain issues? Well, for a client to qualify for the employee retention credit, those supply chain issues have to be related to a government mandate. We're having supply chain issues because companies restricted their output. They laid people off at the beginning of the pandemic because they weren't sure. There was a lot of uncertainty. That reduced the amount of things available, and people are still catching up for that. They couldn't find employees. That's not a mandate. I can't find an employee, and therefore my output has been reduced. That's trickled down to everybody. That's not due to COVID. I have a demand in general went through the roof. The last 2 years, we've gone crazy as a country buying. We have bought more than we ever have, almost, I think it was, close to 20% in the year 2020, more than we did the prior year. Demand went crazy. As demand goes up, supplies go down. You combine that with a lack of employees and people purposely throttling their output, that's going to trickle down to everybody. One other thing, and people don't talk about this a lot, but I've heard that the Texas freeze that happened just over a year ago greatly affected supplies as well. That's not due to COVID-19. So in general, the supply chain issue is allowed. IRS says, yes, your suppliers are affected by a government mandate, then you can qualify. It goes a step further and says, and you can't replace those products elsewhere. The fact that I have to pay 2 or 3 times as much for a product, that's not enough for me to qualify. I have to be able to show that my supplier was affected by a government mandate. They were shut down. Therefore, that trickled down to me. And it had more than a nominal effect on my business. More than 10% of my revenue was affected by it, or more than 10% of my hours worked by my employees was affected by it. If I can show that and show that I couldn't replace that elsewhere, even if the cost was through the roof, cost is not an issue for qualifying, then I can qualify under that supply chain issue. Unfortunately, it's very hard to do. I don't know if anybody else has any comments on that, or is that enough of my soapbox? All right.
That's good.
All right. We're gonna move on to the next question. Does anybody have one? I was ranting there. Nick, Haley, John.
I got one. Yep.
Okay.
Yeah. So there's been a few different questions that come up just around the whole relative issue, and Randy, you can kind of pick up anywhere where I miss anything in here. But so when the IRS came out with the ruling, essentially said, for a lack of trying to go too deep on this, if you have any living relative and you're the sole owner of a business, you can't qualify for ERC for your own wages. So if you're a mom and pop business and it's only you and your kids work in the business or something, you can't take any of those wages. If it's only you working in the business and you have relatives outside the business, you still can't qualify, because they essentially said there's a direct, directly or indirectly owning more than 50%. So it can be, your grandma who has nothing to do with your business. The fact that she's alive, she indirectly owns the same amount of business that you do and is disqualifying you. That's essentially what is happening with the family member, the relatives. It's a bit confusing, but the IRS came out and doubled down on that stipulation, and that's essentially how it works. So the only way you can have like a single member S corp be able to take their their own wages into consideration, is if they literally have no other living relatives, right, Randy? I mean, that's the only scenario we can possibly qualify someone. And the idea behind this was that they didn't want people to be able to funnel wages through family members to beef up their ERC and then bring it back to themselves. And that's the only thing we could think of for why they're doing this. But in doing so, they inadvertently crushed the credit for a lot of smaller mom and pop businesses. Unfortunately, there's no way around this. And there's lots of different ways this works. I know someone else, had a question saying, if it's under 50%, if it's under 50%, you're okay with relatives, right? And is it 50% or less, Randy, or is it under, it's 50% or less?
50% or less, yes.
Yes, so it's direct or indirect. So when you're looking at a business, if say they're a 49% member, they can have living relatives and now they can qualify because they're not over that 50% threshold. So if you have two 50-50 partners who aren't related, you'll be able to take their wages into account. It's when you have a relation there. If you have a 33%, if you have three people who are all 33%, if two of them are related, those two, their wages are going to be ineligible. So that's where the whole, family comes into play with everything. But it's very unfortunate the way that works out, but that is how we have to treat it for that.
Yeah, Congress was surprised that this happened. It wasn't on purpose, but the legislation or the IRS code they pointed to caused this, and unfortunately, we're not going to see a fix on it. So, family-owned businesses, family-run businesses, mom and dad and kids and aunts and uncles, it's just going to get hurt. So, I'm gonna open polling question number 3, and then at the same time, Haley, Nick, I'm going to go to you with some questions. This is actually kind of related to what John, I'm not telling you to do this at all. But some people have told me they thought about doing this, and I'm like, oh boy, especially what you just heard John say, you don't want to do this. But people were saying, hey, I'm going to claim the refund the year I received. I'm going to claim the adjustment the year I received the refunds rather than the year the wages were used. I think people are going to count on the fact that IRS is going to turn a blind eye to this. We have no guidance that says that. We honestly can't do this. But, who knows, maybe we'll get some backdoor information from the IRS saying, hey, we are going to ignore this, but that does not exist right now. So we got most of you voting. While you're voting on this, I'm going to ask Haley and Nick a question that have come out on the 941Xs. So Haley, this first one, I think you've got, so somebody was told by a payroll company, and this is a pretty easy one to answer. Someone was told by a payroll company that the first quarter of 2020 does not need to file a 941X, and that can be put on the second quarter, lump the first and the second quarter of 2020 on one 941X filing. Is that accurate?
Yes, that is accurate. Because there was such a short time period of eligibility in Q1 2020, the IRS did allow clients to file the Q1 credit on that 2020 amended 941X.
All right. Yep. That's right in the instructions. And then Nick, when you were talking, you mentioned that we have to send these in snail mail. Is there an option to fax the 941Xs in?
No, the only time we've had an option to fax is if it's in response to an IRS letter. We had one client who we sent in the 941X. The notice letter actually said it was received, but we have lost it. Can you resend it in? And they give a fax number to send it into. When actually sending it into the IRS, they want you to send it to one of essentially a couple locations based on what state you're in, and you have to snail mail. So.
All right. I'm going to end this poll, and I'm going to share this with you just so you see the results. It's pretty spread out between. Oh. I typed, will not do this, will not do this. I was telling you in this answer, do not do this. A third of you are still thinking about it. So this is my least important thing I do is rating polling questions. So I'm glad that I did not put will do this because I don't want any of you to do this. All right.
Randy, could I just put some numbers around this quickly, just
yes,
to
you should
maybe underscore,
because there's undecided still, so you need to.
For the undecided folks, exactly. So the failure to timely pay penalty can be up to 25% of the tax due. It's not nothing. Plus, you're charged interest. Your client is charged interest on top of the penalty. So this is not nothing. In the case of larger ERC credits, something that might put a client into accuracy-related penalty range, that's an additional 10% of the tax. This could be very expensive if the risk is taken and guidance into these safe harbors is not pursued. The safe harbor, again, being if you act reasonably, meaning filing an amended return within a reasonable time after filing for your ERC, you will get protections from those penalties. And the notice does say that, and in the 2021-49 notice and the information release, willfulness will preclude you from being qualified for this potentially. So I would say that without saying what to do, again, there's a lot of support and incentive for seeking refuge under these safe harbor provisions.
Thanks, John. All right, I'm going to launch the fourth one here in a couple minutes in case any of you have to drop off. Again, as a reminder, we're going to stay on longer because we know some of you were late getting on. We wanted you to get your 50 minutes, and there's still a lot of questions we want to answer. So I'll launch that fourth one in just about a minute. So Nick, I don't know if you want to address this. We got a question on aggregation rules, or I can. You let me know.
Yeah, so someone was asking in aggregation rules, how do we have to look at the brother-sister relationship? You know, can you review how it works for the income for the gross receipts test, and do all entities need to claim the credit? So the short answer is yes. When you have companies who are part of a control group, you need to take it all into consideration and look at it as a whole. So if you have company, you know, A with $1 million in gross receipts, company B with 2 million, and company C with 3 million, you're going to have 6 million for that quarter, and you have to compare it against those three businesses combined for the corresponding 2019 quarter to see whether or not they're eligible. You can't look at just one and say, oh, this one would qualify on its own, so I could take it for just this one. You either qualify the entire group or none of the group, and that's both on gross receipts side and on partial or full shutdown. This is where nominal analysis comes into play. So, and I'm just going to touch on another question that's come up here as well, but the nominal analysis, the 10%, it's not about a 10% reduction in revenue.
Correct. Good point.
It's about, was that portion of the business that was affected by a government mandate, did they make up a nominal portion of your business, right? So were the operations from that part of the business that was affected, were they making up 10% of your total revenue during 2019? If they do, they can be considered a nominal part of your business. So then if that nominal part of your business is affected, then we can go ahead and qualify the company. In a case where you have an aggregation group, you have to prove that the portion that's being affected by the mandates made up 10%, we're responsible for 10% of the revenue of the entire aggregation group in order to qualify them. So you don't have to have a reduction in revenue. It's about finding out, is this a nominal portion of the business by saying, does it make up more than 10%? And it doesn't have to be just revenue, right? I think, Rainey, it could be 10% of like the wages. Yeah, the hours worked of your employees as well is another way to get that the nominal portion documented. And we are very, very specific on doing this when we're qualifying clients. Can we show that nominal portion of it? Do they have the data to support it? Right. And not every time you're going to have the perfect data. And you have to work with what you have. Right. But that's where that 10% comes into play, that nominal portion. It needs to be responsible for either 10% of the revenue generated for your business, or it needs to be 10% of the hours worked, allocated to that portion that was affected by a shutdown. But yeah, and it works in aggregate or individually. So.
Yeah, and so I was just going to point out there's a few questions on different parts of businesses and different industries, specifically some doctor's office that were shut down. Certain parts of their businesses were shut down, and that nominal analysis relates to individual businesses as well. So, for instance, if you had a restaurant, we'll take an easy route. If you had a restaurant that had dine-in, carry out, and like a drive-through, we would look at, okay, well, if your business was partially suspended, your how much of your revenue was taken up in 2019 by that drive-through, by your dine-in, and analyze it in that way. And then additionally, on the aggregation rules, I want to make sure that everybody understands that the aggregation rules only apply to the qualification portion. Of each company would get its own credit, its own calculation after that aggregation. Now, there is some rules where we have to look into the different employees, make sure that between the aggregate group of companies, there's not employees that are hitting over that 10K max per employee, but for the most part, all companies would have their own separate calculation.
Yeah, I didn't touch that. Good point, Haley. Yeah, if you have a 3-person control group, you're gonna be filing 3 941 actus, for each
Per
quarter.
quarter, yeah.
Yep.
All right, I want to let everybody know I did put polling question number 4 up. This is basically asking, have we answered your question yet? If not, please stay on longer if possible. And I know you all can't. Or over there, you can scan that QR code, get your phones out, scan that QR code. It'll pull up an email address. Or again, it's info@tri-merit.com where you can submit additional questions. We are not leaving. We are going to stay on. I have a feeling that we are going to do the same presentation again because we had about 1,000 people not able to get on today, and we will work on timing for that. But I got a feeling that this will go on again. And again, we are not ending now. I am going to end this poll. 96% of you have voted. 97% of you have voted on this, and at least at this point, we've answered 3/4 of the attendees' questions, and 1/4 say that the question has not been responded to yet. So we will continue to answer these questions. I'm ending this poll right now. Hopefully everybody got their 50 minutes in so far. If not, stay on, and hopefully everybody got to answer at least 4 of those, 3 or 4 of those polling questions. All right, so let's go on to more additional questions. We really just addressed this. I'm just going to go a little bit further on this, and Haley just talked about medical offices. Somebody had a specific question on dental. Dental was shut down for preventative and hygiene. You could go in if you were having a root canal or something. There was something emergency. That is considered a partial shutdown. And again, following up with what Nick and Haley just said, we have to show that that preventative or that hygiene was more than 10% of your overall 2019 revenue. If it was, you now are under a partial suspension and can qualify. This one's a little bit tricky. Let's ask this and get some of the opinions. Here we have a question that is somebody to put in. We have a manufacturing company that started up in the fall of 2020. They're considered essential. Manufacturing across the country was pretty much considered essential, other than a few places. In this scenario, their salespeople could not go out and visit potential customers. Not sure the mandates that's restricting that, but let's assume that there was a mandate that restricted. There was a restriction on ability to, have group meetings, one-on-one stuff. Wasn't usually restricted around the country, but let's assume in your scenario, the salespeople were not allowed due to a government mandate to go visit with customers. Now, we're not going to be able to show a revenue drop on this because of a startup. Anybody have an opinion on if that's going to qualify them for a shutdown?
So unfortunately, I would say no. So with sales specifically, we have had plenty of companies come to us with this specific situation. And unfortunately, because sales can be done via Zoom, qualifying it under a government mandate is very, very difficult. And Nick, I don't know if you have any other comments on that.
Yeah, I mean, I kind of agree. When you're talking about these things, you have to have a company that can't easily shift to working remotely. That's something they kind of the IRS talks about a little bit. So, with very little ease, sales can very easily sell over the phone, over Zoom. Yes, there are some scenarios, and anyone who's in sales knows face-to-face is irreplaceable, right? You can do more, more selling face-to-face. It's just a very hard argument to make. It'd be one of those things where I think it's kind of one of those those gray areas where the IRS is going to look at it. They're going to look at it and say, okay, was there a mandate that directly hindered your ability to do sales? They're going to say, like, what are you selling? Like, could you, unless you're, I mean, I can't even think of an example off the top of my head, but if you're selling something where you literally have to have them testing something in person,
So big
maybe,
equipment where you're
yeah,
having to take the equipment in, there could possibly be a case. Another instance that I've had quite often is trade shows, but we would have to show that we would do a nominal analysis in this case and show that 10% of their total revenue or hours came from that trade show. And that would be the only way that I could think of qualifying.
yeah. And even that is tough because, what's the duration of a trade show? 1 or 2
Yeah,
days.
exactly.
Yeah, it's very difficult to try to make that argument. I think with the guidance the IRS has given on this, again, every company is different. It's hard to make a summation like this with information like this, but you have to look at each one individually and say, okay, can we prove that they absolutely 100% had to be, going out and visit these people and maybe their potential customers are shut down. This, I mean, it gets it, you're starting to get into almost a demand argument when you're talking about customers, being shut down because you can't visit them, and which the IRS is against. But there are scenarios, right? I mean, it's, on the topic of the demand argument, there's another question that's talking about a home healthcare business. They actually saw an increase in revenues, but they had a partial, shutdowns because they couldn't send healthcare workers to nursing homes. So do they qualify? It's a tough one, right? You can have people whose revenue goes up and still qualify if nursing homes or whatever used to be, if they couldn't go to nursing homes and they used to be, making up 10% of the revenue, that is their place of work. I mean, that's what it all comes down to. What is the place of work, and can that shift relatively easily? If the place of work is, at a facility, like if you're like we've done a valet company, for example, the valet company's place of work isn't their office that might have been shut down. It's the restaurant. That's where, or they do their work. So there's always going to be some gray areas and you have to take each situation individually, instead of just making a blanket statement like, oh, this industry can't qualify because of this. I mean, every business is unique in how it operates. Obviously, you're going to have industries that are, probably bigger red flags than others based on how you're trying to qualify, but it can be the case. But back to the manufacturing company, even if you couldn't qualify for the partial shutdown, you can at least get the recovery startup in Q3 and Q4 based on them starting in 2020, as long as they meet the gross receipts threshold during 2020.
Yeah, and just to tackle two more, sorry, Randy, just to tackle two
before
more.
you do, sorry, Haley, one real quick thing. I just want to let everybody know, if you want more specific client questions answered, because I've seen a lot of specific client questions answered, you could go in and fill out a form we have. And here's, again, take your phone out, scan this, or go to that web address right there, take a screenshot. You can go to that address where you can fill out information on a client. This is not, this is not anything where you're, tied to us, but it'll get us to analyze this client and see if we can help them or at least answer your question. So if there is client specific, that's where I would go. Okay, I'm sorry. Go ahead, Haley.
I was just going to go over two more industries since we're on the topic of industries. One, we've got a bunch of law firms or attorneys that did not meet the gross receipts decline, but we're wondering about shutdown of courts. Unfortunately, from any that I have researched, we would have to take a portion of only the jury trials that a law firm was engaged in. That's been the only way that I've been able to find. Obviously, states and different counties have different mandates, but and like Nick said, it would definitely be a case by case, but that's what we would mainly look for in a law firm, would be those jury trial dates. Additionally, the other two are churches and nonprofit schools or private schools. Those, again, depends on the state, the local government mandates that were in place. a lot of times for both of those situations, we are able to identify fundraising and fundraising events that did not happen, and that those fundraising events were more than a nominal portion of their revenue in 2019. We have done that quite a few times, so that's definitely something that we can look into.
Nick, did you want to go into, there's a incorrect 941 question 27. Is that something you can address?
Yep. Yeah. So we've had some similar type issue happen. So in this situation, there's talking about the payroll service, prepared a 941X incorrectly. Then they filed a correct 941X. It looks like the IRS processed the incorrect one. Unfortunately, when the IRS processes incorrect things, there's usually not any other course of action we could do besides refiling. And I've talked to the IRS on this, multiple times. For example, we had a client who we filed our 941X and they incorrectly processed it. Like we were requesting a refund for our client. It was, smaller. It was like $5,500 or so. The IRS received it, marked it as processed with a $0 adjustment, and no notes why is adjusted to $0. Nothing sent to us, make an adjustment. So when I called them and asked, I talked to the guy on the phone and he essentially said, there's no notes stating anything separate. Unfortunately, once it's been processed like this, there's nothing I can do. You had to refile. Obviously, it's terrible news because it's taking a long time to process. You just have to refile. When you do refile something, I would write on there second submission. So in case they do find the one you originally filed, like in this case, whether it's lost or they filed the wrong one, make sure they see it. And if you know that an amendment was made, you can always pull that information from the amendment into column 2 when you're filling out the 941X, because it asks for column 1, the adjustments you want to make. Column 2 is what was on the 941 that was processed, which you would now have for the 941X, and now you're going to file for the difference. So you could make, a new filing with it to make sure you're taking the correct amount for ERC. But it was very, again, unfortunately, there's not a better solution than, you have to refile. You can make the adjustments, take into account what they did receive already when you refile. But unfortunately, there's no other course to action. And then just real quick, one of their questions, someone said, where do you check on the IRS e-service for the status of the Forms 941? If you have e-services with the IRS, you're just going to go to the transcript delivery service. And you'll, as long as you have an 8821 on file or a full POA, you're able to essentially go request status of the 941s, and they send it. It comes through in a transcript and pretty much just has line items showing all the different actions the IRS has taken from the original processing of the return to the amended return being received to the adjustment being made and the check being issued. But yeah, so those are those.
Okay. All right, I want to go to John with one here. John, someone's asking about if a company filed for the employee retention credit on a husband and wife, who do not qualify because they're 100% owners of a business, they claim them. Would we recommend, and I know what you're going to say, but would we recommend amending each quarter and paying those funds back?
I would suggest that would be yes. And the reason, again, mitigation. There may be an ability to make a reasonableness argument and avoid penalties, even on the overpayment. So we're talking about refunding, returning the ERC
credit.
Randy, or
Yeah,
the effect on the income. Yeah.
No, the ERC that was claimed for the husband and wife that, till we got clarification from the IRS, we thought maybe that was possible. And so they claimed husband and wife, and really now that we know they shouldn't.
Yeah, that 5-year statute of limitations, that's there for a reason, because their IRS Congress assumed there was going to be confusion, and so they've got a longer period to evaluate these claims, and so that's what I would suggest, is mitigate and even seek reasonable relief at this point on the error.
All right. That's what I thought. I think we're getting through most of these questions now. Anything, there was a specific, and this is not something that I don't even think I have an opinion on, but somebody's asking, if a car dealer client is being told they would qualify on supply chain issues due to government shutting down, and I assume they mean shutting down the auto manufacturer and forcing them to produce ventilators rather than vehicles. Is this something we've run into? Anybody have an opinion on this? I
I've
don't
never seen,
know.
yeah.
And were auto dealer manufacturers shut down and forced to produce ventilators rather than vehicles? I think maybe I remember something like that, but I don't know. All right, something we haven't run into. Sorry, we don't have that answer. We can research it. I think it's going to be very iffy that that's going to qualify somebody, but we shall see. Car dealers in general, that's another soapbox item. Car dealers in general, everybody's telling everybody every car dealer qualifies, and car dealers, yeah, sure. There wasn't a big supply of cars. A lot of it is the chip issue. If you can equate that chip issue back to a government mandate that affected those manufacturers, sure. But in general, car dealers and went through the roof sales wise. And so it's kind of hard to argue unless you can find a more than nominal portion of their business is going to qualify. So that's a tough one in my mind.
Randy,
I-
one thing I've seen which was interesting is fleet sales as the partial shutdown. If the dealer was selling to car rental agencies or car dealerships that or other car dealerships that had rental fleets, that was something I've seen in a case or two where that did affect a substantial portion of their business. Just kind of an outlier, but something that could be a scenario that works for them.
It's something to look at. The IRS specifically talks about if your customer base was affected, and could this be customer base because customers were restricted from traveling, let's say, and so the fleet went down. IRS says customer base effects don't affect you. And so that could be an issue. You'd have to really trace that and see what the effect is. But in general, just because your customers are affected does not mean you qualify for ERC. Unfortunately, I don't agree with what IRS says there, but it is what IRS says. Nick, do you want to address some recovery startup questions at all, or just in general give us some recovery startup?
Yeah, I'll go on this. There was actually another question that came in that's kind of an example. So yeah, recovery startup. I wish they gave more guidance on this. Because you have things that come into play, like does a acquisition count as a recovery startup, for example? And it's tough. I mean, there's nothing that says you can count it. So there's different things to look at, right? Can a company who started up as part of an aggregate group, let's say you have two businesses that are in business and a third business gets started, can that company count as a recovery startup business? So let's look at recovery startup business in general first, right? It has to start after February 15th, has to have average annual gross receipts, for the previous 3 years, for the tax year before the quarter that you're claiming has to be under $1 million. They're capped at a $50,000 credit. And if they're part of an aggregate group of recovery startup businesses, that 50,000 is across all three companies, or multiple. I don't know. I said three, but across all companies. And the same thing with meeting the aggregate rules for the average gross receipts. So, the simplest example, you got a company that started up, let's say like the manufacturer in November of 2020, they have under $1 million of gross receipts, which you do have to approximate out for the year based on the time frame you have. So if we're trying to claim it for Q3 and Q4 2020, which is the only 2 quarters you can qualify as a recovery startup business, you're looking at the gross receipts for 2020 and saying, okay, is it under $1 million when it's annualized? If it is, we're able to qualify. You get up to $50,000 credit. That's the simple one. Now let's say you have a company that's been in existence for maybe 10 years or so. The owners start up a new business. Is that new business going to be able to qualify as a recovery startup if it's part of an aggregate group? Well, if the existing businesses has average gross receipts over $1 million, there's no questions asked. The aggregate group has over $1 million, you can't do anything. Also, is that new business that's starting up just essentially a different segment of the same business? If that's the case, no, we can't qualify as a recovery startup. The only scenario I think we could possibly qualify, and again, this is more of a there is no guidance, gray area type of thing. You have a new business that started up as part of a control group. The existing control group had gross receipts under $1 million in the past. The new business has nothing to do with the businesses that existed. Okay, now it's truly a new business. We could make an argument to qualify that business, again, if the gross receipts test is met by the control group as a whole. So the other business they had, we had one client who came to us who she ran a blog for years, since like 2011. She just started to try to open up an actual business, two businesses actually. One was kind of related to the blog, the other one was not. And we were looking at this like, okay, well, recovery startup for the one that's the business that's starting up that was related, we don't think we could take that treatment from the start date, versus the one that was not related, we did look at and we were able to take that because they weren't over the $1 million average gross receipts threshold. So everything is case by case with this. It can be confusing, but with recovery startup in general, if you're gonna be part of a control group, you can't just be a spin-off of the business that's in place or a new location of the same business or a new segment. You have to be kind of doing something different to qualify as a recovery startup. It has to be its own standalone business.
In an aggregated group.
Yes, in an aggregated group.
Right.
Yep.
All right, we're going to continue to answer some questions. I just want to, if anybody that wants to drop off, I want to give you a couple of insights that I think you'll find interesting. Some of you may have been on the Unique CPA, which is another arm of Tri-Merit's sponsorship conference last year. We're doing a second one this year. If you look at those list of speakers down at the bottom, you should be in awe. It is a great list of speakers. Take my name off there, but look at the other ones. We have very influential people in accounting that are going to be speaking at this event. It is free to you. And it is great information. So we'll have more information coming out on this soon, and just wanted to let you know that. A couple of other things I want to let you know. We are going to start a second monthly webinar. It's going to be practice management topics. That'll start in May. So besides our tax topics, we will now have practice management topics, again, free to you, and great speakers. Dan McMahon will be the first one, which will be May 19th. Our podcast, the Unique CPA, which I host, you can now get free. We're all about free here. You can get free CPE for listening to that on Earmark now. And so go download the Earmark app. You can listen to our podcast and get CPE for listening and answering some questions. And sneak peek, we are starting some peer group programs where we're going to have like roundtable discussions with, let's say, managing partners of like size firms, where we'll go over some topics each month, talk about things that are happening in for you specifically, and then get advice from your peers. It'll be an education as well as a group discussion. So that'll be starting sometime later this year. Again, that one's not completely free, just to let you know, but just want to let you know that that's all out there. All right. That being said, we do have some more questions, and I told you we would stay on as long as we could to answer questions. Haley, we got one that came in for you. You want to just talk about how if you qualify under gross receipts, how that affects the next quarter, qualification?
Yeah, and I'll let Nick help me here too. But the rule is that once a quarter qualifies on a gross receipts basis, the next quarters, the following quarters, all qualify automatically until the quarter after the quarter in which the gross receipts decline is less than 20%. So I know that was a mouthful, but that is a rule. So you will see, I know there was a couple questions on if that was accurate or not. That is accurate. Nick, anything else to add there?
No, I think it's accurate. It's a little confusing because you got to start out at 50% drop for 2020, and then it drop, then you got to maintain a 20% drop. I think that's why 2021, they just left it at 20% across the board. Yeah. But yeah, essentially you're able to use they call it an alternative quarter to qualify, which is the previous quarter versus the corresponding quarter in 2019. And it always has to be taken against 2019. It's someone that had a question saying they were confused about whether it's against 2020 or 20. It's if you have 2019, it's always compared against 2019. The only time you'd compare against 2020 is if you didn't have, you weren't in existence for that quarter in 2019. In which case you'd have to use the corresponding quarter of 2020 if you're claiming 2021. But besides that, everything is looking compared to 2019. It's not a year-to-year thing when you're looking at 2021.
If you
Hey,
guys,
Nick, it's Barry jumping in. Can you clarify the 2020 rules are above 80%, but people were asking a lot about using the prior quarter gross receipts test for qualification, but that only is applicable to 2021.
Yeah, it's applicable to 2020 as well. It's just it's kind of it's phrased differently, but it works the same way. So let's say for clean numbers, let's say 2019 Q2, you had $100,000 of revenue, and then Q2 of 2020, you have $50,000 of revenue. You're qualifying for Q2. You're going to continue to qualify until the quarter after, which you your drop goes to 20%. So Q2, for 2019, let's just say you had $100,000 each quarter. Q2 of 2020, $50,000 of revenue. Let's say it climbed back up to, $80,000 of revenue. That's going to qualify you then for Q3, and it's going to qualify for Q4 at the very least. Let's say Q4, it was $90,000 revenue you climb back to. Now Q4 is qualifying because Q3 did, because it's the quarter after you stop reaching that 20% decline, but now you wouldn't be able to qualify Q1 based on Q4. So it's a little confusing trying to talk it out, but if you get it on paper, it's a lot easier to kind of see how it flows through. But the big thing to know is for 2020, once you qualify for the future, for the following quarter, you just have to have a 20% drop instead of that initial 50% drop. But then 2021, someone just asked, what if it goes down and qualifies on its own? Yeah, I mean, it can qualify on its own. So that's why every single quarter you kind of get 2 quarters to look at, for doing this. So Q1 can qualify based on Q4's numbers from the previous year or based on its own quarters. It's the alternative method. So
and you can jump back and forth. Once you select one, you don't have to stick with it. If I use the alternative quarter, I don't have to stick with that. Every quarter stands on its own, and I can look at it if it qualifies itself or did it qualify from the prior quarter.
Yep. Yeah, that's a big thing. Yeah, the IRS has said like every quarter, they probably say it, I don't know how many times in the guidance, that every quarter has to qualify and on its own with these methods, and it's standalone, right? If you have a government and government shutdown isn't for the whole quarter. I don't know if we clearly explained that, but government shutdown is the exact dates, but gross receipts qualifies you for the entire quarter.
Correct. All right. I just want everybody to know I put a 5th polling question up there. Just because I know some people were having some issues at the beginning logging in. And so if you want to go answer that 5th one, I've had it up for a handful of minutes already, 2.5 minutes. So I'm going to close that out in a minute, but I just wanted to, some people must not have seen it. So they're going to, people are just listening and not looking. All right. So they are going to vote there. So I'm pretty much seeing most questions answered at this point. If we didn't specifically answer yours, we feel it was addressed in another answer. And if you still feel that it was not answered, again, go to here and submit it via email. And we will get to it. I think at this point, there's still 220 people on, which is amazing to me. But I think we're going to have to shut it down. Here's one question that we really didn't address. And so let's do this, but I honestly don't know if I understand the question. So somebody else could tell me if they know. This is specifically for law firms. It says, Rent furlough by government mandate may be more than nominal if more than 10% came. Okay, I'm guessing they're asking, hey, if we're a law firm and we handle bankruptcies and we weren't handling bankruptcies because there was a rent furlough and so people weren't going bankrupt, I guess is the question. Is that a mandate? I don't see how that would qualify. I don't know if you guys have an opinion on that, or if you understand what I said.
Well, Randy, if there are boutique firms that are just bankruptcy firms, and if their work evaporated,
Oh, there you go.
and
Good point.
you can't just shift over to do tax law and such, and so that might be arguably a partial shutdown.
Well, if the mandate, but this is again going to customer base and my customers were affected, is that going to affect me then? Do I have that right, Nick? Do you have an opinion?
Well, again, and someone asked to expand on the demand argument. Demand argument's hard. I think the reason why the IRS tried to squash the whole demand argument is, you have companies who might have customers in every state, every county, sometimes cities, counties all had their own rules. How do you figure out what's a government mandate? What's not, what's the time period? I think just the burden of trying to do that is absolutely crazy. And I think that's why they went that route. But I think it goes back to the, is it the customer being, I think we go back to the argument again of what is the place of work? Are you producing your items, selling it, shipping out to customers everywhere? The place of work's at your, facility where you're producing the items. Are you doing something where your people are literally working inside of the customer's business, every single day, and that can't be done remotely, right? Like the valet offer, example we gave. I think there's a couple others we've talked about.
Catering, if you're catering
Yes,
in convention center setting, let's say conventions were shut down, the caterer generated the revenue from being there serving the food. It's not their place of business. I think that's a good argument that they were shut down because that catering, that convention center was shut down.
Yeah, we've had staffing companies that have come to us, and hotels and staffing. That's a whole nother rabbit hole to go down. But the staffing company, they were they had a lot of focus on the restaurants inside the hotel, and those restaurants were essentially hit and shut down. And so that they had enough of their staff was for the restaurants and not for the rest of the hotel, where we were able to make that nominal analysis and see, it was well more than 10% of their revenue from their employees working at the restaurant portion than the hotel. So their place of work was the restaurant, right? So it's the demand argument. Once you can't establish that place of work, I think it gets extremely iffy to try to go down that route. But that's the only way we kind of see to be able to justify this with the IRS. And even at that, I mean, there's gonna be lots of tax court cases around this, and it's gonna be all over the place. It's not something we're probably gonna know until it's all said and done and too late with some of them, which is a shame. But it's kind of comes with the ground. So you got to kind of make a determination: is this something we can really justify and make an argument for, or are we trying to maybe stretch a little bit too much, and we can't fully justify this with numbers?
Yep. And the one thing I would point out that we didn't address really, and this is going to be the final point here, is that we are not up against any deadlines right now. The very first deadline we're going to hit to file an amended 941X is next July of 23. That is our first deadline. And so we have plenty of time to see if there's more clarifications. We have plenty of time to see if there's court cases like Nick just addressed that is going to give us something to rely on. And so at this point, if it's not a cut and dry credit, I would highly recommend waiting. Some people want that money sooner, but if we feel that something else could shake out in the next year, and then we really have over 2 years before the final one is filed. So we have quite a bit of time to go back and capture this money for taxpayers that are not in a cut and dry shutdown rules applied, gross receipts qualified. If we don't have one of those that we feel very confident, then let's wait and see what happens in the next year half. Anybody else have any final thoughts? All right. All right.
Nope,
Well,
I think it's good.
I just want to let everybody know this will be on YouTube as early as tomorrow. I got a feeling that this will happen again because we did have a great turnout, and unfortunately, 2/3 of the attendees couldn't make it on today. Scan this. I got scans all over the place for you. So here's another scan. This just takes you to Tri-Merit. You can get to any of those other things that I had you scan before. You can get to our Meet the Team there. You can get to the ERC submission form there. You can get to the info at email there. You can get to more ERC information. So you can get to everything through this. In addition to all of our email addresses will be on these slides and at the Meet the Team section. So I want to thank everybody. I'm sorry there was a little somehow confusion with the CPA Academy people, but we still had I think nearly 500 people get on. So thanks, and thanks everybody for helping out. Barry and Danny behind the scenes, and Mark Reese as well, and Haley. Other Haley, not on camera Haley, but on camera Haley, Nick, and John. Thank you very much.